So now we can start on financial statement analysis. So it's all about summarizing the financial information that you are given. And in this case, we have three major tools of financial statement analysis. Number one, we'll be evaluating is what we call the common size analysis. Number two, we have the comparative analysis. And then number three, we have the normal ratio analysis. Yeah, those are the tools in financial statement analysis, which are used to summarize some financial data to other stakeholders of the company, even those without the financial knowledge. You see, for example, in an income statement or financial statement, only some accountant can be able to interpret. Only some accountant can be able to interpret. But you see an investor who is not financially literate, and you see in this case, they want maybe to make a financial decision, whether to invest or not to invest. There's some information they look. For example, if you look at the earnings per share, dividend per share, that's some information they can be able to comprehend. So in this case, we'll be looking at the three of them. Now, starting with the common size analysis. Yeah, common size analysis is a tool used whereby you express the financial statement items into a base case, of which is classified into two. We have what we call the vertical common size analysis. And number B, we have horizontal common size analysis. So those are the common size analysis, whereby in vertical common size analysis, we express all the financial statements under for one base case as percentage of base case, whereby we have the income statement. Also, we evaluate the statement of financial position. Statement of financial position. You identify a base case, and then you express all the other items in the financial statement to the base case. You hold base case to act as 100%. For the income statement, the sales or the revenue will act as the base case, whereby you hold the revenue to be 100%. Then you express other items as percentage of sales. For example, the cost of sales you express in percentage of sales, gross profit the same, operating expenses, tax, like that. Then to the statement of financial position, the base case will be the total assets or total equity and liabilities. Total equity and liabilities. So that's the vertical common size, whereby in this case, you are comparing all the financial statement items into a base case, whereby you hold the base case to act as 100%. What about the horizontal? Now, horizontal is also known as the trend analysis. Trend analysis, whereby you are comparing the performance of the company over a given period of time. So, for example, you are comparing 2023, 2024. So that's what we call a horizontal analysis. In this case, for example, if you're comparing 2 years, 2023 and 2024. Now, one financial year becomes the base year. That is, for 2023 will be the base year. This one will be the base year, whereby you hold all the items for that financial statement as 100%. Then you compare against 2024. As simple as that. Good. Then comparative. Comparative here, it's more of the trend analysis. But in this case, we are more concerned about the absolute changes. The absolute changes. Whether it's an increase, whether it's a reduction. And if it's an increase by how much? A reduction by how much? And then lastly, we have financial ratio. It's all about evaluating the financial information into proportion, whereby under financial ratios, yeah, so we have profitability ratio. You can use profitability ratio, gearing ratio, liquidity ratio, efficiency ratio, or the turnover ratio. Which are the ratios? Yes, and the leverage or the gearing ratios. Good. So now we can use our notes. Let's discuss what we have in our notes. Now, financial statement analysis is the process of analyzing the company financial statement for decision-making purposes. It's all about summarizing the financial information so that you can be able to make the decision. Now, external stakeholder uses it to understand the overall health of the organization, as well as to evaluate financial performance and the business value. And we have three major tools of financial statement analysis. One is a common size analysis. And number two, we have is comparative analysis. And number three, we have is ratio analysis. I will start with the first one, that's the common size analysis. Common size analysis. Now, common size analysis is classified into two. Number one, we have the vertical analysis. Number two, we have horizontal analysis. What's the difference? And now let's start with the vertical analysis. Now, in vertical analysis, in vertical common size analysis, each account or item in the financial statement will be expressed as a percentage of base case account. Can you understand that? Percentage of base case account. Percentage of base case account. Good. Yeah, how do we identify, or what are the base case for the income statement and the statement of financial position? The second point is that the base case account for the income statement is the sales revenue. Underline that the income statement, the base case will be the sales revenue. And therefore, every item in the income statement is expressed as percentage of sales, holding sales revenue 100%. This type of analysis allows the analyst to determine how various components of the income statement affects the company's profitability. So that's all about the income statement. For the income statement, the base case will be the revenue. You hold the revenue 100%, then you express all the other items in the income statement as percentage of sales. Second, the third point. Now, the base account for the statement of financial position, that's the balance sheet, is the total assets or total equity and liability. Also underline that. And every item in the balance sheet, that's the statement of financial position, is expressed as percentage of total assets, holding the total asset as 100%. Good. So I want us to do that illustration. Do that illustration one. So consider the following financial statement of Air Vibes Limited and prepare vertical common size income statement. So we have Air Vibes Limited income statement for the year ended that 1st of December 2020, whereby you have the revenue, you have the cost of sales, gross profit, we have all that. So we have the income statement. And under the income statement, we have the revenue. We have the cost of sales. And then you get the gross profit. Then we have admin expenses. Then we have the distribution expenses. That you get the operating profit. That's the EBIT. It's also what we call the operating profit. And then you add the investment income so that we get now the earning before the tax. You raise the tax expense, and that's how we get the net income. The revenue we have is 30. What we have is 12. And that's how we get the gross profit of 18. 15. 12. We get 15, 300. 500, get 15,800, and the tax is 3. Then we have 12,800. So now we need to perform what we call the common size vertical analysis. Now in vertical analysis, we have seen that. How do you express the items? So if you're performing the income statement, common size analysis, we say that for the vertical analysis, you hold the revenue to act as the base case. So this one will act as the base case, and therefore you hold it as 100%. Once you hold it 100%, you express all the other items as percentage of sales. What does that mean? Now, this is what you can argue. That 30,000 is equivalent to 100%. What about 12,000? Now, can you give me that? X one getting is? Yeah, you are getting 40. What about the gross profit? 30,000 is equivalent to 100%. What about 18,000? You get an amount of 60. So now in that case, you'll be taking, for example, this one will take 12,000. You divide by 30,000 times 100%. This one will be 18,000. You divide by 30,000 times 100. 1,500. You divide by 30,000. You have 12. 30 times 100%. I have 15,300. 30 times 100. So here I have is 500. Also, the net profit is 12,800. You divide by 30%. So give me that. So this one we had 40%. This one you got was 60%. 5%. This is 4%. Sorry? 51%. 1 point. Give me 2 decimal places. 67%. 52.67%. This must be 10%. Last 3. 40.67%. Good. Then from that, now the key elements that you factor. Number 1 is the gross profit. The other one is the operating profit. That's the EBIT. And the other one we factor will be the profit after tax. So in this case, the net profit, for example, the gross profit is 60% of the sales. The operating profit, that's the earning before interest and tax, is 51% of the sales. And the net income is 42.67%. What does that mean? So what it means is that, for example, if you work with the profit after tax, because that's the entire profitability of the company, we can comment that for every 1 shilling of sale, 0.4267 shillings is the profit. That's what it means, that for every 1 shillings you make of the sales, 0.4267 will be the profit. Yeah, also, that mostly will be applicable by the external stakeholders as well as the management, but everything to the management is very important. Cost of sale is 40%, so that one will give us the gross profit margin. The admin expense during the year attributed to 5% of the sales we make. What about distribution? Distribution was lower than the admin expense, which was 4% of the sales. And that we have the operating profit. The operating profit was 51% of the sales. Then we had investment income. Investment income is not an operating income. It's income we get from the money the company invests. So in that case, it had contributed to 1.67% of our sales, or equivalent to that. And then tax. The tax we paid was equivalent to 10% of the sales. So what does that mean? That means that for every 1 shillings of sales, 0.1 shillings goes to the government in form of taxes. And then I've already explained the net income. It's as simple as that. So I want us to do now one for the statement of financial position. And for the statement of financial position. Second page, we have illustration 2. Now consider the following financial statement of Evervibes Limited and prepare the vertical common size balance sheet. Vertical common size balance sheet. So how do we prepare that? So we have the statement of financial position. We have PPA. We have the intangible assets. We have investment property. Then we get the total. Then we have the current assets. But we have the inventories. We have trade receivables. Then we have cash at bank. We can get the total current assets. That's very important. Then we can be able to get the total assets. Then we have equity and liabilities. But we have the ordinary share capital. We have the share premium. Then we have the retained earnings. Then we have the non-current liabilities. Have 10% debentures. Then we have the current liabilities. But we have the trade payables. Then we have the bank OD. Good. So that's what we have as a statement of financial position. So if you are performing the common size vertical analysis for the statement of financial position, yeah, remember, what have we said that will be the base case? Yeah, the total assets. Now, this one you hold it as 100% all the total assets and liabilities. So this one you hold it to be 100%, or also this one will be 100%. Then you express all the other items of the statement of financial position as percentage of the total sales. Now, for example, PPE, you'll take 22,000. You express as percentage of the total assets. So you divide by 6,500. This one will be 12,000. Divide by 6,500. 5,000. Then you multiply by 100%. Good. So give me in percentage. 22 divided by 60.5 to get how much? That's 6 point? 36 or 37? There is 19.83. 8.26%. 64.46%. 15.7. Sorry? 19%. 0.83%. That's 5.54%. That's 3.06%. 9.92%. 19.67. 19.83. Last three. No, we have two of them. 10.58%. 6.94. So as simple as that. So in that case, we can, for example, how do you interpret such information? Now, for example, if you want to determine how much did the company or the total investment in the intangible assets. So for example, PPE represent that 6.67% of the total assets. Our intangible assets represent almost 20% of our total assets. Investment property. Is that what are investment property? They are property which are held for sale. Are held to earn rental income or for capital appreciation. Yeah, that means we can say that of our total assets, 8.26% they invested in investment property. Now we go to the current assets. Now the current assets, they'll give us the liquidity element. How liquid is the company? Because here we have the working capital items as well as the cash and cash equivalents item. Yeah, the current assets is what establishes the liquidity of the company. For example, our total assets, inventory is 15.7%, receivable 19%, cash and bank is 0.83% of our total assets. And then 35.54% represent the current assets. Of the total assets, that 5.54 represent the current assets. What about the equity? What about the equity? That means that 3.06% of our total asset is represented by the ordinary share. Or we can also say that you see these assets are part of investment. So part of the investment was financed. That 3.06% came from the issue of shares. That's what it means. And then share premium represents almost 10% of our total assets or total equity and liability. And then the retained earnings represent almost 20% of the total investment in our company. Yeah, so that means it's very important. What does that mean, Pride? When it comes to the investment and gearing level, yeah, this one has a very deeper meaning. When you say your retained earnings is 19.67 of the total investment, what does that mean? That means this company mostly, they use the retained earnings to finance their assets, which is equivalent to what they're using in long-term debt. See, they're almost equal, right? Yeah, so that means of total investment, 19.83 were financed by the long-term debt. That's what simply means. Because in this case, we can see that the debenture represents 19.83% of the total assets or the total equity and liability. Then we have current liability. Now, current liability, they are also part of working capital and cash equivalents, whereby trade payable is 10.58. Now, trade payable and receivable, 19%, payable 10.58%. What does it imply? You know what gives rise to receivable, right? What? Credit, sales. What about the payable? Credit purchases. So in terms of now, though we have not done that, no, you're not the one to do that. It's going to be done by those taking financial management. You see, of our sales on credit, it represents 19%. What about? We are supposed to pay the supplier. We owe supplier 10.58% of the investment. Who is lenient? Is it us or our supplier? Us, correct. Because you see, for us, we have a big percentage of those who owe us than what we owe our suppliers. Good. Yeah, that's what we call financial statement analysis. It's all about trying to analyze and to narrow down to make the financial statement understandable, even by someone who has no financial background. Good. So that's all about the vertical common size analysis. Good. We go back to our notes, page 3. We look at now the horizontal. The horizontal can only be used. Now listen up to this, because sometimes we'll be given a question and then you are told that perform common size analysis without mentioning whether you are conducting the vertical or horizontal. Now, horizontal is the same as trend analysis, whereby you are comparing one period against another period. That means if you are given two companies for one period, maybe this company 2023, 2023, that one is not horizontal. That one you perform vertical. Horizontal, you can only compare one company over a given period of time. And now let's go to that. Now, under horizontal analysis, each account value is expressed as percentage of designated base year account value. Can you underline base year account value? Yeah, this allows the analyst to see how the items have changed over a given duration of time. Also underline that, over given duration of time. Yeah, and the horizontal analysis is also known as the trend analysis. Yeah, so that means in this case, you're saying that when performing the horizontal analysis, you identify the base year. So it's not a base item, it's all about the base year. For example, if you have two periods, let's assume this was 2020, we have 2021. all the item of 2020 will be held as 100%. All the items, be it the revenue, cost of sales, gross profit, 100%. Then you compare against for the other period. We do that illustration. Now consider the following financial statement for Everbs Limited and prepare horizontal common size item, income statement for year 2019 and 2020. So here we have two periods. We have Everbs Limited income statement for the year ended that first December. We have 2019 and 2020. So (2019) of 2020. And so we have that information. So we have to perform the trend analysis or the horizontal. So in this case, we have two periods. You are comparing 2019 and 2020. So what you'll do, you identify a base year. And in this case, 2019 will be a base year, whereby you hold all the items as 100%. Like that. Then for 2020, you express them now as percentage of the base value. For example, in this case, 30,000 was equivalent to 100%. What about that 4,000? Can you do that? To get 113, right? So it's the same as taking now this 34 over that. So here I'll take 34 over 30 times 100%. And this one will be 12.5 over 12 times 100%. 21.5 you divide by 18 times 100%. 1.2 you divide by 1.5 times 100%. 1.8, 1.2 times 100%. And here you have 18.5, 15.3 times 100%, 0.2. Just write it the way it is. 200 over 500 times 100%. 18.7, 15.8, 100%. 4 over 3 times 100%. 14.7, 12.8 times 100%. So give me that. Now the first one you're getting, was it 113? 113. Like that. 0.33%. 104.17. 119.44%. 80%. 150%. 120.92%. 40%. 118%. 133. 133.33, right? Last three. 0.84. Simple. What does that mean? So that means 2020 sales or revenue was 113.33% of that of 2019. So in short, there was an increase by 13.33%. Our cost of sales for 2020 was 104% of that of 2019. That shows there was an increment by 4%. But now, that increment of 4%, now that one will take us to the next tool of ratio analysis, not ratio analysis, of tools of financial statement analysis, comparative. So this one is trend analysis or common size. The other one for comparative is more of this, is more of the trend analysis, but that one is concerned by the change. You see, in this case, we are taking 113%. So the other tool, you only factor in the change, either an increase or a reduction. So in that case, we'll be taking 13.3%. For example, in this case, we can say that admin expense was 80% of that of 2019. So how much is the change? That's a reduction by 20. Now, the other tool, that's the comparative analysis. Now, that's what we factor in. So in this case, we factor in the 80%, but the other method, that's when we factor the absolute change. Good. So all that. So that's how you perform the trend analysis or the horizontal common size analysis. The same will be applicable to the statement of financial statement, whereby you get a base year, then you express the other year as percentage of the base year. Good. Take a 1 minute break, then we come and discuss on the second method. So now let's proceed. We look at the comparative financial statement analysis. When do I need? Good. Don't need this. So the second tool is the comparative financial analysis. Now, comparative statement deals with the comparison of different items in the profit or loss account and the balance sheet of two or more periods. Can you add two or more periods? Yeah. So that means also that one you can only use or you can only compare one company of a given period of time. Let's start with the income statement. Now, three important information are obtained from the comparative income statement. One is the gross profit, operating profit, and the net profit. The change or the improvement in the profitability of the business concern is determined over a period of time. Now, there is something I want you to underline there. Can you underline the change? The change, good. So in this case, we'll be concerned about the change. Maybe, has it increased by 10%, 20%, 30%? That's what we need. Now, in this case, we are not concerned about the change. We are concerned about the full proportion. Then we have the comparative statement of financial position. Now, the financial condition of the business concern can be found out by preparing the comparative statement of financial position of the balance sheet. The various items in the balance sheet for two different periods are used. And we have an illustration there. Illustration. Consider the following financial statement for Everbs Limited and prepare comparative income statement for year 2019 and 2020. So we have the same information here. So here we are concerned about the change. So what you do, how do you get the normal percentage change? See that to get the normal percentage change, first of all, you get the rate of change by taking P1 minus PO over PO, whereby P1 minus PO, that's our absolute change. And if you want to express in percentage, that's why you divide it by the base case. So here you have two periods. So this one will be PO, this will be P1. I explain something else. We have 2009, 2010, 2011. You are doing trend analysis for 3 years. So this one will be PO. What about for 2010? P? What about for 2011? P2. There is nothing like that. It can never be P2. It becomes P1? P1. So when you're comparing 2009 and 2010, this will be PO, this will be P1. Now, when you're comparing for 2020, now 2010 becomes PO, this one becomes P? P1. There is nothing to do with the P2 here. Are you together? So now with that information, now we get the absolute change. And to get the absolute change, you take P1 minus PO. You want to determine whether it's an increase, whether it's a reduction. If you get a positive, that's an increase. If you get a negative, that's a reduction. Revenue was from 30 to 34. Increase, decrease. By how much? 4,000. An increase by 500. An increase by 15 to 12. A reduction by how much? A reduction by 300. An increase by 600. An increase by That's 2. An increase by an increase by how much? Is it 2900? 3 to 4. An increase by? What about the profitability? An increase by how much? Is it 1900? Confirm. Is it 1900? Yes, 1900. Good. Then from there, we compute now the percentage change. To get the percentage change, you take P1 minus PO over PO, of which in this case we have P1 minus PO. So for example, in this case, you'll take 4,000, you divide by the base case, which was 3,000. So you'll take 4,000, you divide by 30,000. This one will be 500, 12,000. I will take 35, you divide by 18,000. 300, you divide by 1,500. 600, you divide by 1,200. That 200, you divide by 15,300. 300, you divide by 500. 29, you divide by 15,800. 1,000, you divide by 3,000. 1,900, you divide by 12,800. Then you expect it in percentage. So this one you multiply by 100%. Now give me in percentage. The first one must be 13.33, right? 4.17%. 19.44. Sorry? 20. But this one will be negative, was a reduction, right? 6 out of get 50%, right? Sorry? 20.92. 3 over 5. Negative? Yeah, 60%, but was a reduction, so it's negative. 18.35%. That 3%. Sorry? 13.84%. Yeah, that one is indicating the absolute change. What does that mean? That means our revenue increased by 13.33%. Cost of sales increased by 4.17. Gross profit increased by 19.4. Admin expenses reduced by 20. Now you stop thinking like accountants. Now you think like managers. You know, what I'm explaining here is what you can explain as a what? As an accountant. Now you think like managers. As a manager, now let me pick something and then you explain to me. Our revenue increased by 13.33%. What attributed to the incremental revenue? Msiniambie sales. Someone is saying sales. See, these are the sales. Okay, what made sales to increase by 13.3? You are telling me sales. Reduction in? No. We are not talking about the profit. We are talking, don't think like an accountant or don't think like a student. Now you think like a manager. Are you together? Revenue has nothing to do with the expenses. If evaluating expenses, you should be evaluating the profit. Are you together? Now you think like a manager. I'm training managers here. What can attribute to the, see where you work there, do you generate revenue? Or if you have a kiosk, does it generate revenue? Good. Now the question is, what can attribute the incremental? Don't look at this company. So is a common knowledge for any business. What can attribute to the incremental in revenue? Sorry? Yeah, marketing, incremental marketing. or the marketing efforts, because if you don't let other outsiders to know your product, you will never sell. And that one also will have an effect when it comes now to the admin marketing expenses. That's one. Think like a manager. Increase in stock. Quality of goods, but quality and sales. Okay, there is a point there. Lakini kwa umbali. Change in money. Yeah, increase in product demand. Demonstrate demand increases. Now, that's where your point now comes in. Due to quality. You know what happens? Customer do communicate. Ulipata wapi ego yako? Let me tell you somewhere. They give you the contact, you contact. Why? Because number one, this is what happens. If the customer is satisfied, you retain them and you get a referral. True or false? Good. Increase in demand. What else? Sorry? Hata hiyo asikii Kenya unasema. Increase in production. But now production, production has nothing to incremental sales. Sorry, the tools used. Also the tools used, what can happen? They can only lower operating costs, but they cannot have an effect in revenue. Discount around? Yes. Discount is another factor. Because sometimes when a business is offering discount, what happened to the demand? Increases. Actually, that's one of the strategies to enhance incremental sales, offering discounts. Another one? Sorry? Yeah, promotional initiatives. Yes, you encourage them to buy more. You can win this. So they do bulk purchasing, all that. So now I can see you are thinking like managers. Sorry? Yeah, the after sales services. Yeah, after sales services to any customer is very important. Yeah, and there's something you are saying. Yeah, less competition. Yeah, also less competition is another thing. Because this is what happens. Assume that you had 3 shops around you, A, B, and then one was affected. What will happen to you? Number one, the market share, you start sharing with the remaining one. So that means, meanwhile, what happens? It's like, for example, you have a business somewhere, and then one of your competitor crosses. What will happen? So number one, the customer, if they are still around, number one, you'll have to garner some customers. What about inflation? Inflation is one of another key point. Let me tell you one thing, and that's why we'll come to discuss about one disadvantage of ratio analysis. It does not factor inflation. Why? Now, assume I have a petrol station. And then you remember there was a time we had subsidy, right? Whereby 1 liter will go to 160. Now the subsidy was removed. You pay 180. That means if per day I was selling 1,000 liters, all factors constant. Here, how much you recognize as a revenue? 1,000 liters, each at 160, because the price is lower. How much will be a revenue? 160,000. Then the same, the demand has not gone up. But now due to new taxes, remember you as the seller, this is not your money. It's the money you are collecting on behalf of the government in form of taxes. 1,000 you sell at 180. How much will be your sales? You see now, you can bounce and say that your sales increased, but in real sense, you see, it was due to inflation. The same happened with unga. When it was 100, when it was 200. What was happening? You see, you can sell the same quantity, different prices, but this was due to inflation. So you cannot say that the business is doing great. No, one of the limitations of the inflation of ratio analysis is that does not factor in inflation. We're still thinking like a manager here. What of Forex thing? Yeah, the foreign exchange. That one is very correct. The foreign exchange rates. Because, for example, Give me a product that mostly they are exported or they imported, like a car. When the dollar is 135, and when the dollar was 1, what will happen? Because number one, as a seller, you quote based on the market or the exchange rate. So that means if you use a rate of 135 Kenyan shillings to 1 USD, and when the dollar was high, you see, in this case, you are selling the same unit, but at different prices. You cannot say that in that case, I made more profit. No, but your sales generally recognize more revenue. Now let's select something else. Yes. It's another point. Could you just say, sorry? Okay, I'm not getting your point. Retail? Oh, the pastel. Yeah, that actually pastel by the way is the point, but now it will have to affect everything. Pastel is works from the political, also that one can also influence your expenses. Right together. Economical, such as inflation is there. What else? Social. Yes, because when you increase the price of hunger, what will happen to the consumption? There are no source, right? You get it? That's part of social. Yeah, all that. Let me pick another item. There was a reduction. Gross profit, that one has no effect. Let's come to admin. Admin was a reduction by 20%. What could attribute to the reduction in admin expenses? Now assume I'm a director of your company. Assume I'm a director of your company. I'd ask you some question. You have to convince me to invest your company. So now you as an accountant there, you are the CFO, Chief Financial Officer with Masters and PhD. Then you present this information and then I ask you, I can see there was a reduction in admin expenses. What happened? What attributed to that? Use of technology like AI. Number one, that one was the operating cost. Yeah, AI soon is coming to replace you. That's the bitter truth. Another one. Sorry? Operating? Yeah, operating during the off-peak. And that mostly happens. You know, before, there was time way back when even this CPA was only taught normal hours or weekends only. No evening classes, no early morning classes. But what happened when these things are introduced? You have a supermarket that was operating only 12 hours. Then you decide we'll be operating 24 hours. Are you getting my concept? Yeah, so what happened? Due to economies of scale, because you know, if you operate for 24 hours and you operate for 12 hours, rent, what will happen to the rent? It remains to be the same. But what has happened to your revenue? Correct. Another factor, wages. So what happened to wages? Jack, you decided to put our to cards, right? Yeah, it might also be a strategy whereby there is layoffs to cut on cost, merging of department. You have some department, instead of duplicating, you merge them, tell others to go home. So what will happen to admin expenses? That's all. Also, yeah, it's called, yeah, correct. That's the right word to use. Restructuring. You merge department, free up some space. You don't have to pay all that rent where the activities are being duplicated. etc. Good. Now that's all. That was not part of the class. I was trying now take you to think like I'm a manager. Yes, Kaiser. And I answer you. No, capital rationing cannot. Capital rationing affects the investment and the asset base. But now you have used a heavy term. Most of these people, for those even not taking FM this time, they may not understand what is capital rationing. Do you know what's capital rationing? Yeah, you see that silence, Most of them, they don't understand. What is capital rationing? Yes, I have one who knows. Yes, it's shortage of investment funds to undertake all viable projects. Yeah, you see that one cannot affect our admin because we invest mostly using the equity, we issue the shares to get the cash, we borrow or the retained earnings. So that one cannot affect our admin expenses. Good. So now let's look at advantages and disadvantages of this. So advantages of common size analysis or comparative. You can also write stroke ratio analysis before you come to discuss about the ratios. So there is advantages in page 5. And then we have the one in page 6. So the one I want us to use is the one in page 6. Advantages of ratio analysis. They are the same. In page 6, there is the advantages of ratio analysis. They are the same for even comparative or that. One advantage of ratio analysis, number one, is that they are used to determine the ability of the company to meet financial obligation. That's the liquidity ratio. We'll come to that. That's what we'll be discussing next. About the categories of ratios. What are the classification of ratio? There are 5. We have profitability ratio, liquidity, gearing or the leverage. Profitability was number 1. There is efficiency or turnover or asset utilization. And number 5 is the valuation ratios. Are we together? Each ratio has its own advantage. For example, profitability, they have to determine what? Profitability indicates the ability of the company to generate returns. What about liquidity? Yeah, it indicates the ability of the company to meet its short-term financial obligation. What about leverage or gearing? It indicates the level of which the company has used the debt to finance its assets. What about valuation ratio? Yeah, they also determine the value of the company, such as MPS, EPS, dividend per share, dividend payout ratio. What about turnover or efficiency ratios? They are the ratios which are used to determine how the company utilizes their assets, the level of asset utilization. Now let's go through the advantages. They are used to determine the ability of the company to meet its financial obligation. Now that one is courtesy of liquidity ratios. Number 2, they indicate the extent to which the company has borrowed funds, courtesy of the gearing of the leverage ratios. Also, they are used to compare the performance of the company with that of the industry. You know, you always compare yourself against the industry. Yeah, that one is known as what? Industrial analysis. Yeah, when you're comparing your company against the industry. Also, there is when you're comparing your company over time. It's known as what? Trend analysis. That's what we have discussed here. Comparing a company over a given period of time. That's trend analysis. Also, when you're comparing your company against competitor, not the industry now, but now against your competitor. Cross section, correct. Yeah, number 3, we are saying that. Number 4, they are used to compare the performance of the company with other competitors. That's what we call cross-sectional analysis. Also, they can be used to compare the performance of the company over time. That's the trend analysis. Also, ratio are used to determine the value of the company, courtesy of valuation ratio, etc. What about disadvantages? Now, I want you to get disadvantages once and for all. There is something I was explaining here about the price of unga and petrol. What was the disadvantage? Yeah, it does not take into consideration the inflation. Then number 2 is that it uses accounting data, which can be manipulated by an accountant. Not just the accountant, by the management. So for example, the management, they want to deceive the investors that our profit increased by 20%, not 14%. So what will happen here? They'll have to manipulate their financial statement. So because we are using accounting data, which is prone to manipulation. Another thing is that it uses historical information. Remember, using financial statement. One of the characteristics of the financial information is that it's based on historical nature. And that's why we prepare the financial statement at the end of the financial year after all the transactions have already happened. And remember, that's the information to use as an investor to make your decision about the future. So that's another disadvantage. Another one, it only captures the quantitative element. We are capturing numbers. Therefore, it ignores the qualitative. You know, qualitative in a company is very important. Goodwill, employee peace of mind, also dressing code. That one, okay, there is something else I wanted to mention, but let me not mention, which is not captured here. Are we together? Yeah, so therefore it only captures the quantitative, therefore ignoring the quantitative element. Yeah, another thing is all about the location. Location is not part of quantitative, it's part of qualitative. Yeah, ratio ignores that. Good. And then also, in case it's a monopolistic company, that means it doesn't have a competitor. So therefore, you cannot compare your company against other company. Also, ratios does not take into account the size of a company. How many disadvantages have you understood? Now let's go through them. Now, one is that ratio ignores the effect of inflation. Also, difference in size of companies. Yeah, that means does not take into account, you can write in bracket, does not take into account the size of the firm. Weather condition, firing of employee, advertising your product. That's good. The other one is difference in accounting policies. Yeah, sometimes it will be difficult to compare the performance of to compare the company with another company when the accounting policies are different. There is what we call accounting standard. Accounting standards are the same, but accounting policy are different. For example, how you depreciate an asset is not about the standard. It's all about how the management may decide. We may have two firms, A and B. A having a ROI worth 10 million, B having a ROI worth 10 million. But A, they decide to depreciate their ROI at the rate of 20%. They decide to depreciate at 10%. Do you see the difference in depreciation? Remember, this one will affect the admin expenses. So that means it doesn't take into account the accounting policy. So we're having the same outcome, but in this case, the accounting policy will give differing outcome. For example, in this case, you show 2 million as depreciation, but another company in the same industry with the same asset, they are showing an amount of 1 million. So what will happen, for example, if you decide to classify them as admin expenses? So that means your expenses will be twice as my expenses. So therefore, what will happen to the absolute change? It should not be the same. Good. Another one is that ratios fails to capture the qualitative aspect of the company. Also, in case of monopolistic company, it's difficult to compare performance. Also, window dressing. What is window dressing? Window dressing. Yeah, it's a financial term used to refer to the manipulation of financial statement. Yeah, manipulation of financial records. Good. Then we have financial ratios. Now, for those who have done financial management, I just copy pasted. So you have financial ratios. Now I want to give you 3 minutes. I'm the one taking a break. You are not the one taking a break. Me, I'm just coming here to do some illustration. Now, can you go through the financial ratios? Just look at the formulas. So here there is nothing to explain about the formula. Formula I cannot explain. Formula you understand or you cram. That's all. For example, how do you get the profit margin? How do you get the gross profit margin? Gross profit on what? Ratio can be categorized into 5 categories as follows. We have investors or valuation ratios, and those are the ratios that shows the value of the company. Number 2 is the liquidity ratio. They are the ratios which is used to determine the ability of the company to settle short-term obligation when they fall due, gearing or leverage or solvency ratio. There are ratios which indicates how the company has borrowed to finance its operation. Profitability ratio, that one I cannot explain, you already know. Then we have activity, efficiency, or turnover, or asset utilization. There are ratios which are used to determine the ability or how well the company utilizes their assets. I just go through that. Just look at the ratios. You look at the formulas there. Look at the formulas. I gave you 3 minutes. Then I come and do some illustrations there. So now let's do the illustration. There's the illustration 1, the one for Bonoko Limited. Now, the following are the summarized financial statement of Bonoko Limited. So we have the income, we have statement of financial position as at 31st of December. So we have 2015 and we have 2016. I'm using the one that is typed, not the illustration that is handwritten, the one that is typed. So we have two financial year, 2015 and 2016. Then we have also the income statement. Then we have the notes. Under the notes, we have the retained profit brought forward. Then we have the dividend paid during the year. Required. For each of the years, calculate 1, earnings per share. So EPS for each of the year. So we have 2015, 2016. I want us to compute for each year. How do we get the earnings per share? How do we get the earnings per share? To get the earnings per share, you take the total earnings attributable to ordinary shareholders, and in that case, that is the profit after tax. But in case there is any preference dividend, you deduct. But in this case, we didn't have any preference dividend. And then you divide by the number of ordinary shares. We have the profit after tax. 2015 is an amount of 9520. 2016 we have it's an amount of 11,660. And then you divide by the number of shares. The number of shares. How do we get the number of shares? So you take the ordinary share capital, you divide by the par value. If you're not given the number of shares, that's how you determine. Can you see the ordinary share capital? Yeah, for 2 years we have it 9920. You divide by the par value of 0.25. It's the same for the 2 financial year. So how much do you get? 29? 680. Good. So therefore, to get, you divide by the number of ordinary share, that 9680, that 9680. What do you get? 2015 into 2 decimal places, 0.2416. .29. So what has happened? If you are told to comment, what can you comment? Yes? There is a? Yeah. Number B. A dividend cover. How do we get DC? Now, dividend cover, it indicates the number of time through which we can pay the dividend out of the profit. The number of times we can pay the dividend from the available profit. This is what I mean by DC. For example, if you earn a salary of 100,000 and your rent is 25,000, how many times can you use your earnings to pay your rent? Good. That's DC. So to get the dividend cover, you take the earnings per share over dividend per share. We determine the number of times through which you can pay the dividend from the earnings. So earnings per share, here we have is 0.24. Here we have is 0.29. You divide by the dividend per share. How do we get the dividend per share? You take the total dividends, you divide by the number of ordinary, number of ordinary shares. 2015, 2016. How much is the total dividend for 2015? So you are given under the notes, eh? Can you see that? 2240, and this was 2400. Then you divide by the number of shares. How many shares do we have? Yeah, that 968. So that you determine the dividends per share. Sorry? 2015? 6. 0.0. Now can you do this? Also do this. Can you take 95? Take 9520. You divide by 2240. 4 point? So this one is 0.06. Also this one is 0.06. Now give me that. This one you get? This one you get? Yeah, this is 4 times. This one you get? Yeah, 4.8. 4 times. Number C, current ratio. Now, current ratio is one of the easiest. Yeah, it's the current asset of a current. Yeah, they are part of liquidity. And what's the recommended ratio for current ratio? Yeah, the recommended ratio is 2:2. Well, yeah, that means that the current asset should be as twice as the value of the current liability. That one is provided in your notes. How much of the current assets? Add the total current asset. For example, 2015, you take 40, 155. All simpler, you take 97, 442. You minus non-current asset, you remain with the current. You get 52. I mean 92. 447, eh? Now let's do the same for 2016. Get 90. 99,615, eh? Yeah, so you take the current assets, then you divide by the current liabilities. And for the current liability, we have an amount of 36, 862, and here we have is an amount of 14, 42, 475. That 2 point, 51 times, or you can show 2.51 is to 1. What about this? Times, or you can show 2.34 is to 1. So that means in terms of liquidity, this company is performing better because the recommended ratio should be 2 times. Now, in this case, we are above that. What does that mean? That means our current asset is 2.51, that of the current liability. So it's above the threshold of 2.1. So in terms of liquidity, the performance is okay. Number D, acid test. Acid test, you take the current asset excluding what? Yeah, you exclude the stock so that you remain with the most liquid current assets, and then you divide by the current liability. So you take 92,447, you deduct our inventory, which is 40,145, over the current liability of 36,862. Here you take 99,615, you deduct the inventory, and our inventory is how much? 50,455. And then you divide by the current liability, 42,475. 2015, 1.42 is to 1. This one is? Wow. Yeah. For the quick ratio, the recommended ratio is 1:1. Yeah, but in this case, we are above 1. So that means in terms of liquidity, we are doing well. Good. Lastly, is return on capital employed. Now, first of all, check. Do we have the debt in the capital structure? How do you get the return on capital employed? Return on capital employed. That is part of profitability issue. Can you go back to the profitability issue? Where you get now profitability in relation to investments. You take the net profit, you divide by the net assets or the capital employed. But if the company is all equity financed, what do you mean by all equity finance? That means if they don't have the debt in the capital structure, it's also allowed to determine the return on capital employed by taking the operating profit, that's the EBIT, you divide by the net asset. Are you together? But in this case, we have the debt in the capital structure. So you take the net profit, which is the same as profit after tax, 9520. Here we have it 11,660. You divide by the net asset. Net asset is the total asset minus current liability or equity and long-term debt. How much do we have? Can you see it? It's there. You take the total asset minus current liability. This is what I mean. For example, the first one, you can take 2015, you take 97,442. That's the total asset. You raise the current liability of 36,862. What do you get? You get? Then I want also we confirm. Can you take your equity? You add non-current liability. Equity plus non-current liability. Are you getting the same? Okay, have you understood what I have told you to compute? I said that you take the total assets minus the current liability, or you take equity, you add non-current liability. Are you getting the same outcome? Yes. But now in this case, now that's what we are supposed to do. But in this case, we had already been given the net asset. Now let me explain. I want to explain how they have gotten their net asset. Now this is how they have gotten their net assets. They have taken the total asset minus total liability, including the long-term liability. Sometimes it's also allowed to do that, but not in financial reporting, in financial management, whereby you may have a loan that is due in 1 year time, 1 month. 1 year, 1 month. In financial reporting, that one qualifies to be an non-current liability. But you see now, that amount is due in almost 1 year, but now has exceeded by 1 month. So in that case, they can also classify it as part of the net asset. And that's what they have done in this case. Total assets minus the total liabilities, including the 10% loan note. What does that mean by that 10% loan note? It's not that long term. Okay, I know you are getting confused. You just know that to get the net asset is total asset minus current liability. But in this case, they had already been given you the net asset. So use the one what you have given, which is 40,740. And then all the profitability ratio, they express in percentage. This one you take 50,000. What do you get? 23.37%. What about here? 23 point. So actually the concept about ratio analysis is getting the formula. If you have the formula, that's all. If you have the formula, that's all. Because for example, you see on this case, it's all about the formula. If you know the formula, application is very simple. Earnings per share, profit after tax over the number of ordinary share. You just take the profit after tax. If you don't have the number of share, do you know the formula how to get the number of share? You apply that. Then number two, dividend cover. It requires the earnings per share. That means you didn't get the earnings per share, even the second one you won't get. So I want you to try the second illustration. Then you mark for yourself. The answer is already there. Now illustration, there is something I want to give an adjustment there. Let's go to illustration 2. The one about ulimwengu. The one about ulimwengu. I told that the following is a summary of financial data of Ulimwengu Limited for the financial year ended that 1st of December 2017 and 2018. We have the income statement, we have the statement of financial position, then we have additional information. Additional information, you have the number of shares outstanding, 2018, 2017, the number of shares. Here we have is 28. Here we have also 28. Those were the number of shares. The number of shares. Then required. Now, before the required, there is some information that is missing there. I want you to add price earning ratio. Just add below that. Price earning ratio 14, 13. Just before the required. Yeah, that's an additional information. Add that. Good. Yeah, so now you can be able to follow that. Yeah, so, and that marks the end of that topic. Good. So we are done with that topic. We'll do more illustration during our blocks revision.